Welcome back to the Multifamily Deep Dive by Bridgewater Realty Advisors, and that this is the overview of the March 2026 of the local multifamily market report. The multifamily experts in South Louisiana, Mississippi, and Alabama. We really have a wild one for you today.
Yeah, wild is honestly an understatement right now. The numbers we're looking at are just completely paradoxical.
Right. Because if you look at the headlines, rents are falling at their fastest pace in years. And, the national labor market is showing some pretty visible fractures.
Mhm.
But then simultaneously, you have these millionaire investors who are suddenly just scrambling to buy up apartment buildings.
Exactly. It's like the ultimate real estate paradox.
It really is. I mean, if the rental market is cooling off so much, why is the buyer momentum suddenly heating up? So today, for you listening, we are going to solve that mystery.
It is a massive contradiction on the surface,
Yeah.
but once you pull back the curtain on how capital actually moves through the economy,
Mm-hmm.
I mean, it makes ruthless mathematical sense.
And that is our mission for you today. Whether you are actively hunting for your next investment property, or maybe you're holding on to a 12-unit building and just sweating over a vacant apartment.
Which a lot of people are doing right now.
Absolutely. Or even if you're just fascinated by the invisible economic gears that dictate where we all live and, how much it costs, this deep dive is built for you.
Because we're taking the March 2026 Multifamily Market Insights Report from Bridgewater Realty Advisors, and we are stripping away the jargon.
Right. We're turning that really dense institutional data into clear, actionable intelligence. Because, let's be honest, reading a standard commercial real estate report is usually a completely miserable experience.
It really is.
It's like trying to read a stereo manual in a foreign language or like a medical journal to figure out why your knee hurts. You just get buried in terminology and walk away more confused than when you started.
Yeah, you see this wall of metrics, cap rates, yield spreads, basis points, and your brain just naturally tries to reject it. But if you ignore those numbers, you miss the actual narrative. Because behind every single one of those percentage points is a brutal tug of war.
Right.
It's a story about human psychology, about the literal cost of survival, and about these massive pools of wealth desperately trying to find a safe harbor.
Which is exactly why we're going through this specific report, because Bridgewater Realty Advisors is the leader in multifamily sales in the region.
Yeah, they absolutely are.
Why? Because they are absolutely on top of all these data points for their clients. They aren't just guessing based on some national headline. They are underwriting the deals happening right in our own backyards, and today you get to sit in on that intelligence.
And the overarching theme you need to keep in your head as we go through all of this is transition.
Transition, okay.
Yeah. The market of the last 3 years is dead. It's gone. We are basically standing in the middle of a bridge, moving from an era of totally paralyzed capital into an era of calculated, aggressive repositioning.
Okay, let's unpack this and start building that bridge. But we really can't start by just, analyzing a fourplex in Metairie. We have to zoom all the way out first.
Right. We need the macro picture.
Exactly. We need to look at the macro weather report because the local real estate market does not exist in a vacuum. It is entirely at the mercy of the macroeconomic climate.
Which dictates everything. The cost of debt, the cost of living, where the money flows.
So let's start at the very top of the financial food chain. The Federal Reserve. They held their March 18th meeting, and they did exactly nothing.
Right. They held interest rates steady, which honestly was the most heavily anticipated nothing in the entire global economy.
Nobody was shocked by that.
No, the market had completely priced that in. But the context surrounding that pause is what actually matters.
Explain that. What's the context?
Well, if you look at the collective psychology of the bond markets and, the big institutional investors right now, the consensus has really solidified around June.
June.
Yeah, June is when the market actually expects the Fed to finally initiate a rate cut.
I want to pause there, though, because I think it's so easy for people on financial news to just say the Fed cuts rates without explaining the actual plumbing of how that hits a real estate investor.
That's a great point. Yeah.
When we talk about the Fed holding steady, we are really just talking about the federal funds rate, which is what banks charge each other to lend money overnight.
Right.
So how does that abstract overnight number dictate what a guy in South Louisiana actually pays for a mortgage on an apartment building?
It's basically a domino effect of the cost of capital.
Uh-huh.
So when the Fed holds their overnight rate high, it sets a floor for every other type of yield in the economy.
Okay.
U.S. Treasury bonds have to offer a competitive yield to attract buyers. And commercial real estate mortgages, which are usually tied to metrics like SOFR or the 10-year Treasury yield, they price their interest rates at a premium above those government bonds.
Right, they have to make a profit.
Exactly. So when the Fed says, we're holding steady, they're keeping that floor elevated, which means a multifamily investor walking into a local bank today is still looking at commercial debt sitting in the mid to high 6% range.
Or even over 7%, depending on the asset.
Easily over 7 in some cases.
Which is incredibly painful. I mean, if you bought a building 3 years ago with a short-term loan at 3%, and you suddenly have to refinance at 7%?
Your debt service just doubled. It's brutal.
So this June expectation, it's absolutely critical for these investors.
It's the light at the end of the tunnel.
Yeah.
And June carries extra weight because it aligns with Governor Warsh's first meeting.
Right, the new leadership.
Yeah, and when you introduce new leadership into the Federal Reserve, you naturally introduce a new philosophy.
Yeah.
The market is really betting that this new regime will lean toward a much more accommodative stance.
Which makes sense. They want to make a mark.
And for over a year, investors have just been trapped in this high interest rate holding pattern. It's basically been a massive staring contest.
Between who?
Between buyers who want lower prices because their debt is so expensive, and sellers who flat out refuse to lower their prices because they're still anchored to those crazy 2022 valuations.
Ah, right, the Mexican standoff.
Exactly. So having a timeline, even just a loose expectation of June, it changes the calculus completely. It moves investors from paralysis to preparation.
But let me throw a wrench into that preparation, though, because the Fed only cuts rates when they feel they have officially defeated inflation, right?
That's the theory, yeah.
But the report we are looking at highlights a very clear hiccup in the inflation data right now. Specifically, it points to this short-term pressure on inflation metrics caused by the war with Iran.
Right.
And obviously, we just want to be super clear for the listener. We are strictly looking at this impartially. We're purely looking at the mechanical economic impact of the conflict on global oil prices, just like the report outlines.
Absolutely.
Yeah.
We have to be incredibly precise here. We are analyzing a major geopolitical conflict purely through the lens of its effect on economic data, because oil is the baseline commodity for the entire global supply chain.
It's in everything.
It is the fuel in the cargo ships, it's the diesel in the 18-wheelers, it's even the raw material in petroleum-based products like asphalt roofing shingles or the PVC piping you use in plumbing.
So when the conflict causes the oil markets to panic and a barrel of crude spikes in price, that extra cost doesn't just sit on a spreadsheet on Wall Street.
No, it bleeds into everything. It cascades immediately.
Give me an example of how that hits a local owner.
Okay, say you are a landlord in Mississippi and you're trying to renovate a unit. The cost of transporting the lumber, the drywall, the appliances, that just went up.
Because of the diesel?
Exactly.
Yeah.
Your contractor is paying more for gas to get his crew to your property, so he naturally raises his bid. And at the exact same time, your tenant is paying an extra $40 at the pump every single week.
Which means they have way less margin to absorb a rent increase.
You nailed it. So that oil spike introduces immediate upward pressure on the broad inflation metrics the Fed monitors. It interrupted what had basically been a very smooth downward glide path for inflation.
Which brings up the dreaded T word, transitory.
Oh boy. Okay.
Because the report notes that analysts view this oil-driven inflation spike as a transitory issue rather than some systemic rot in the economy. But I have to be honest, hearing economists use the word transitory gives me absolute PTSD from 2021.
You and everyone else.
Right. Back then, they told us the inflation from printing trillions of dollars was just a temporary glitch. Why on earth should anyone believe them this time?
I completely don't blame you for the skepticism. The term was horribly abused a few years ago, but the actual mechanism is fundamentally different today.
How so?
In 2021, we had a systemic structural inflation crisis. The money supply had expanded artificially, and global supply chains were just physically broken by the pandemic.
Right. Too many dollars chasing too few goods across every sector.
Exactly. But what we are looking at right now with oil is an external geopolitical shock. It's a massive disruption, absolutely, but it is isolated to a specific commodity market due to a specific conflict.
Okay, so you are saying the underlying engine of the economy isn't overheating. Someone just temporarily clamped the fuel line.
That is a really fair way to look at it. The structural drivers of inflation, like wage spirals and unchecked money printing, those have largely been reined in by the Fed's aggressive rate hikes over the last 2 years.
Makes sense.
So while a spike in oil makes the current month's data look pretty ugly, It doesn't mean the Fed has to panic and start raising interest rates again. They understand they need to just let that external shock absorb.
Okay, let's shift gears and talk about the domestic indicators, specifically the third pillar of this macro weather report, the labor market.
Yeah, this is where it gets tough.
It really is, because this is where the story gets very sobering for the average person listening. The job reports have been coming in weaker than expected.
Consistently weaker.
And consumer spending, which, correct me if I'm wrong, makes up roughly 70% of the entire U.S. economy.
Roughly 70%, yeah.
It is showing undeniable signs of softening. It's like the economy has been sprinting at full speed for 3 years and is finally pulling a hamstring.
That's a great analogy. The American consumer is finally just exhausted. I mean, for 3 years, we saw this incredible phenomenon of revenge spending.
Oh, yeah, everyone was traveling.
Traveling, eating out, upgrading their apartments. People were just burning through their pandemic stimulus savings and completely ignoring the rising cost of living.
But that savings buffer is basically gone now.
It's completely gone.
Yeah.
Credit card balances are at absolute record highs, and the interest rates on those credit cards are just punishing right now.
And it isn't just that people are out of cash. The actual landscape of employment is shifting under their feet. The report explicitly highlights the continued, measurable impact of AI and automation on the labor market.
Yeah, and we need to stress that this isn't science fiction anymore.
No, not at all.
It is not some theoretical white paper about robots
Yeah.
in the year 2050. It is happening right now in 2026.
What does that actually look like on the ground?
We are seeing a real hollowing out, particularly in white-collar and middle management sectors. Companies are suddenly realizing they can deploy AI agents to handle customer service, basic copywriting, data analysis, logistical planning.
Stuff that used to take whole teams.
Exactly. They don't need a department of 20 people anymore. They need a department of maybe 5 people who just manage the software. They're actively finding ways to increase their operational leverage while reducing their human headcount.
And I'm looking at the anecdotal evidence mentioned in the report, and it lines up perfectly with what you hear just talking to people locally. It is a brutal job market right now.
It's really tight.
We are seeing sustained layoffs, both regionally here in the Gulf South and nationally across major corporations. The leverage has completely flipped.
It really has. Think about 2 years ago. If you were a mid-level tech worker or like a marketing manager, you could demand a massive sign-on bonus and permanent remote work.
And you'd probably get it.
You definitely get it. But today, you are fighting 200 other applicants just to get a first-round Zoom interview.
And that loss of leverage means wage growth has basically stagnated for the average worker. So let's tie all of this macro data together before we look at the properties themselves.
Let's do it.
We have an exhausted consumer whose wages are flat. They're facing a brutal job market, dealing with temporarily higher gas prices, and carrying really expensive credit card debt.
Right.
That is the reality of the person who has to write a rent check on the first of the month.
It's a tough spot to be in. But on the flip side, the real estate investor is looking at a completely different set of metrics. While the renter is struggling, the investor's underlying fundamentals are actually showing signs of life.
Tell me about the insurance piece, because the report notes that insurance markets are finally showing improvement.
Oh, we have to unpack the insurance piece, because it has been the single biggest deal killer in this region for the last 3 years.
I've heard absolute horror stories.
They're all true. Following the massive hurricane seasons earlier in the decade, the global reinsurance market essentially just pulled back from the Gulf Coast. They looked at their risk models and decided it wasn't worth it.
So what did that do to premiums?
It caused local property insurance premiums to double, triple, or even quadruple. I mean, I've personally seen apartment buildings where the insurance cost went from $500 a door to $2,000 a door in a single annual renewal.
Wow, $2,000 a door. That instantly destroys the net operating income of a property.
It obliterates the profit margin because you can't raise rents fast enough to cover a 300% spike in your insurance bill. You just can't.
You absolutely cannot. But now, as the report indicates, that extreme pressure is finally easing.
Yeah, new capital is slowly entering the insurance market again. The risk models are stabilizing. And while premiums are still very high historically, the actual rate of increase has stopped. And in some cases, premiums are even slightly contracting.
So when you combine that stabilizing insurance expense with the expectation of the Fed cutting interest rates in June,
The macro tailwinds for real estate investors are getting stronger by the day.
so the investor sees daylight, but the renter is drowning. That brings us nicely to segment 2 of our deep dive, the rental market correction.
Yeah, this is where the rubber meets the road.
If the tenant's wallet is squeezed from every single direction, what does that do to the landlord's bottom line? The short answer from the report is the great pandemic rent boom is definitively, officially over.
It is not just slowing down. It has hit a brick wall and thrown it in reverse.
I'm going to read the hard numbers straight from the Bridgewater report, and I want you to break down the mechanics of this for us.
Go for it.
U.S. rent prices declined 1.5% year over year in February. The national average rent is now sitting at $1,357. Now, to the average person, a 1.5% drop sounds like a rounding error.
It sounds tiny.
Right. But in commercial real estate, this is a seismic event. This is the second lowest level since February 2022, and it is the largest annual drop since the economic freeze of the 2020 pandemic.
We want to put that 1.5% drop into perspective because you really have to look at the peak to understand the pain landlords are feeling right now.
Okay, what was the peak?
Since the market peaked in August of 2022, national median rents have actually fallen by 5.9%.
Wow.
Yeah. In real dollar terms, that is roughly $85 less per month that a landlord can charge for an average unit.
Okay, let's just do the math on that really quickly. Because if I own a 150-unit apartment complex and my average rent drops by $85 a door,
That's a huge hit.
that's $12,750 a month just vanishing from my top line.
Right.
Over a year, that is more than $150,000 in lost revenue. And my mortgage payment hasn't changed. My property taxes probably went up.
Exactly. It compresses your margins violently. But, and this is a massive but, that we have to acknowledge to understand the full picture here.
Okay, what's the catch?
Even after that 5.9% drop from the peak, the report points out that rents are still roughly 18% higher than they were in early 2021.
18%.
Yeah.
That is wild.
It just illustrates how absurd the rent bubble of 2021 and 2022 really was. Landlords pushed pricing so aggressively and the market absorbed it so rapidly that even today, after the largest correction in years, the baseline is still significantly elevated.
So the landlords aren't exactly going bankrupt from this specific drop.
Not bankrupt, no. But the trend line has violently turned against them.
And the clearest indicator of that trend line is a metric the report calls leasing velocity.
Yes, leasing velocity is crucial right now.
For anyone listening who isn't managing a property, leasing velocity is simply a measure of time. From the day a tenant moves out and you list the apartment as vacant, how many days does it take to get a new paying tenant to sign a lease and move in?
Right.
And right now, the national average is 40 days.
I really want the listener to internalize what 40 days of vacancy actually feels like to a property owner.
It's terrifying, isn't it?
It is. 40 days means you lost an entire month's rent, plus a third of the next month. Meanwhile, the clock on your expenses does not stop ticking.
The bank still automatically drafts the mortgage payment on the first.
Always. The utility company still bills you for the water and electricity you needed just to show the empty unit.
And it's 40 days on average, which means some units are leasing in 20 days, but others are sitting totally empty for 60 or 70 days.
Exactly.
The report notes that this 40-day average is 4 days longer than it was just a year ago, and it is more than double the pace of mid-2021.
It's a completely different world.
I remember talking to property managers in 2021. They would put a handwritten for rent sign in the yard of a duplex, and they would have 5 applications with deposits paid by sundown.
It was a landlord's absolute dream scenario. They didn't even have to clean the carpets. People were taking units as is out of pure desperation.
But today, the landlord is the one sweating.
Oh, absolutely. What do you think happens at day 30 of a unit sitting empty?
Panic sets in.
Total panic. The report details these aggressive tactics landlords are being forced to deploy now. They can no longer just hold their asking price and wait it out. They are actively slashing the advertised rent, and more importantly, they're offering massive concessions.
Okay, walk me through the plumbing of a concession. What does that actually look like on paper, and why do landlords prefer it to just permanently lowering the rent?
Sure. So a concession is a temporary incentive to get a tenant through the door. The most common one you see is 1 month free rent on a 12-month lease.
Right, you see those banners everywhere.
Exactly. Or perhaps waiving a $1,000 security deposit, or maybe throwing in free covered parking for 6 months.
Okay, but why not just drop the rent by $100 a month?
Because landlords strongly prefer concessions because it protects the paper value of the building.
Explain that. Why does the paper value matter more than the actual cash in their pocket?
Because commercial real estate is valued based on its income. If you have a unit priced at $2,000 a month, and you drop the official rent to $1,800, you have permanently lowered the gross potential income of the building.
I see.
When you go to sell or refinance that building, the bank looks at that lower number and values your building less. It literally drops the asset value.
But if you keep the official lease at $2,000 and just give the tenant their first month free,
The bank still sees a $2,000 a month lease on the rent roll.
it's a sleight of hand.
It is an absolute accounting illusion. But from the tenant's perspective, if you get 1 month free on a 12-month lease, your effective rent is basically reduced by roughly 8.3% over the course of the year.
So the tenant gets the deal and the landlord keeps their valuation.
Exactly. But the fact that landlords are heavily leaning on these concessions right now is the ultimate proof that the leverage has shifted completely back to the renter.
So we have to ask the obvious question. Why the sudden reversal? How did we go from multiple applications in one day to landlords basically begging people with free rent?
It's the perfect storm of variables.
So what does this all mean? The report lays out a very clear contrast between the 2021 frenzy and today. Let's just look at the variables. Back then, we had massive stimulus checks flooding checking accounts.
Right.
We had the remote work revolution, where people decided they suddenly needed a second bedroom for a home office. And critically, we had historically cheap debt that allowed developers to borrow money for practically nothing to start building new apartments.
And every single one of those variables has completely flipped today.
Every single one.
Yes. The stimulus money is gone, burned up by inflation. The remote work trend is stabilized, and in many cases, it's actually reversed with these strict return-to-office mandates.
Right.
But the biggest factor, the absolute hammer hitting the rental market right now, is supply.
The new buildings are finally finished.
Yes. Remember all that cheap developer debt in 2021? Well, it takes 2 to 3 years to build a large multifamily complex.
Right.
All those massive projects that broke ground during the boom are finally obtaining their certificates of occupancy right now in 2025 and 2026. The market is just being flooded with brand new Class A apartment units.
So if you're a renter, suddenly you actually have choices again.
Exactly. Why would you pay $2,000 for an older unit with, like, a rattling window AC when the brand new building down the street is offering the exact same price, plus a month of free rent, plus a rooftop pool?
You wouldn't. It creates a downward cascade.
Exactly. The Class A buildings poach the tenants from the Class B buildings, which forces the Class B owners to drop their rents to poach from the Class C buildings.
And at the exact same time, supply is peaking, demand is shrinking because the renter is financially exhausted, just like we discussed in the macro section.
Yeah, the report paints a really stark picture of renter behavior right now. They are actively downsizing.
Moving out of 2 bedrooms into 1 bedrooms.
Exactly. Just to save $300 a month. Or they are doubling up. We are seeing a massive return of the roommate dynamic.
Which makes sense if you can't afford rent alone.
People who moved out to live alone during the pandemic are realizing they simply cannot afford the math anymore, so they are moving back in together. And every time 2 individuals who live separately decide to share an apartment, you literally destroy 1 unit of housing demand.
Wow. And when demand shrinks while supply explodes?
Prices have to fall. There's no way around it.
I understand the mechanism, but this brings us right back to the central paradox of this entire deep dive. Segment 3. The Great Capital Migration.
This is the fun part.
You just spent 10 minutes explaining how landlords are losing leverage, rents are dropping by $85 a month, vacancies are doubling, and new supply is flooding the market.
I did.
If I am sitting on $5 million of investment capital, why on earth would I look at that bloodbath and say, yes, I want to buy an apartment building right now? Why is buyer momentum surging?
Because you cannot look at real estate in isolation. Capital is like water, right? It constantly flows to the path of least resistance and best return.
Yeah.
To understand why money is rushing back into a softening real estate market, you have to look at the alternatives. You have to understand the spread between risk-free yields and cap rates.
Yeah.
This is the absolute core of the Bridgewater report.
Here's where it gets really interesting, but let's establish some ground rules here because we cannot use those terms without defining them for the listener.
Fair enough.
What exactly is a risk-free yield and what is a cap rate? Explain it like I am 5 years old.
Okay, a risk-free yield is exactly what it sounds like. It is the return you get on your money when there is zero chance of you losing your principal.
So safe money.
Right. The classic examples are a U.S. Treasury bond or an FDIC-insured high-yield savings account. You give the bank or the government your money, and they guarantee you a specific percentage return. No late-paying tenants, no broken water heaters, pure safe yield.
Got it. Now, what is a cap rate?
A cap rate, or capitalization rate, is the expected rate of return on a real estate investment property based on the income it generates, assuming you bought it with all cash.
Run the math on that so it's concrete for us.
Let's say you buy a small apartment building for $1 million. After you collect all the rents for the year, and you pay all the operating expenses, the taxes, the insurance, the maintenance, you are left with $60,000 in pure profit.
Which we call net operating income.
Exactly. You divide that $60,000 by your $1 million purchase price, and you get 6%. Your cap rate is 6%.
So the cap rate is basically just the yield of the building.
Precisely. Now, the difference between the risk-free yield at the bank and the cap rate of the property is called the yield spread.
The yield spread, okay.
I like to call it the anxiety premium.
The anxiety premium. That is a brilliant way to frame it.
Think about it. If the bank is paying you safe money, the real estate has to pay you more to compensate for the brain damage of dealing with tenants and toilets.
Right. So let's look at the timeline of this great capital migration, tracking that anxiety premium. Let's go back to the frenzy of 2021 and 2022.
Okay.
During the pandemic, the Fed dropped interest rates to zero. That meant risk-free yields were practically zero. Your savings account was paying you, what, 0.1% interest?
It was essentially dead money.
Mm-hmm.
I mean, if inflation is running at 2% and the bank pays you zero, you are actively losing purchasing power every single day.
You are being punished for playing it safe.
Exactly. So capital was forced to go out further on the risk curve to find a return. Investors looked at real estate, which was offering cap rates of 4, 5, or 6%.
That was a massive yield spread.
The anxiety premium was huge, so billions of dollars flooded into real estate, which is what drove prices through the roof.
But then we hit the traumatic shift of 2023 and 2024. Inflation goes out of control, and the Fed panics. They raise interest rates at the fastest pace in modern economic history.
And suddenly, the entire landscape violently flips. Because the Fed raised rates, the banks suddenly started competing for deposits. Suddenly, high-yield savings accounts, HYSAs, became the greatest investment vehicle on the planet.
I remember looking at my bank app in late 2023 and laughing. It felt like a cheat code.
It was a cheat code. You could open an app on your phone and put your cash into a completely risk-free, federally insured account paying 5% or even 5.5% interest.
So think about it from the perspective of an institutional investor or a wealthy individual. Why would you take on the immense operational risk of buying an apartment building at a 5.5% cap rate?
Dealing with insurance crises, evictions, dropping rents.
Right. Why deal with that when you can literally do nothing, take zero risk, and make the exact same 5.5% in a savings account?
You wouldn't. The anxiety premium dropped to zero. The spread vanished completely.
So what did the market do?
The market reacted logically. Capital entirely abandoned the real estate sector. Sales volume plummeted to historic lows. Investors parked their money in these high-yield accounts and just sat on the sidelines.
They became paralyzed by the safety of high-interest cash.
Exactly. Which brings us to the tipping point. The exact moment we're living in right now, in the spring of 2026. Because that cheat code is expiring.
As we established in Segment 1, the market expects the Fed to start cutting rates in June.
Right. And the banks know this, so they are proactively lowering the yields on their savings accounts. You aren't getting 5.5% anymore. You might be getting 4%, and it's trending downward every month.
Meanwhile, real estate prices have slowly adjusted downward over the last 2 years, which means cap rates have expanded slightly.
Which means the yield spread is opening back up. The anxiety premium is returning.
And the report focuses heavily on a very specific mathematical threat to investors right now: negative real returns. Break down how an investor actually loses money in a savings account.
A real return is simply your investment yield minus the rate of inflation.
Okay, give me an example.
Let's say you have $1 million sitting in a high-yield savings account. The bank drops your interest rate to 4%. So you make $40,000 a year.
Sounds nice on paper.
It does. But because of the geopolitical oil shocks and sticky service costs we talked about, inflation is running at 5%. That means the cost of everything you buy goes up by $50,000.
So even though my account balance went up by 40 grand, my actual purchasing power went down by 10 grand.
You experienced a negative real return. You are essentially paying the bank $10,000 a year in invisible wealth destruction just to hold your money.
Ouch.
Sophisticated investors understand this math intimately, and they will not tolerate it. They realize that sitting on the sidelines is no longer safe. It's a guaranteed loss of wealth.
That is the trigger. That is exactly why the momentum is shifting.
Precisely. The anecdotal evidence from the Bridgewater brokers is crystal clear on this. They are fielding calls every single day from investors who have millions parked in cash, watching their yields drop and realizing they have to reallocate into hard assets that historically outpace inflation.
Wait, let me push back on you here because I think there's a missing variable.
Okay, what's that?
If I am an investor and my savings account is losing to inflation and I know the rental market is softening, why not just dump all that cash into the stock market? Why deal with real estate at all?
That's a fair question.
I mean, the S&P 500 have had massive runs. Artificial intelligence stocks are creating billionaires overnight. Why buy a duplex in Mississippi when I can buy shares of a tech giant?
I'm really glad you brought that up because the report addresses that alternative directly.
Yeah.
Yes, specific sectors of the equity markets, like AI, are booming. But the broader stock market is characterized by extreme volatility right now.
It's all over the place.
We are dealing with global conflicts, massive national debt, and deep uncertainty about corporate earnings in a softening economy. The stock market is a roller coaster.
And a lot of real estate investors just don't have the stomach for a 30% drop in their net worth because a CEO missed an earnings call.
Exactly. For a massive segment of the investing population, especially those preserving generational wealth or managing retirement funds, they do not want the wild swings of the equities market. They want stability.
They want to sleep at night.
They want an asset that produces tangible monthly cash flow. Real estate is a physical, hard asset. You can touch the bricks. People will always need a place to live, regardless of what an AI algorithm is doing on Wall Street.
That makes total sense.
As cash yields drop, real estate reclaims its historical position as the premier vehicle for diversification and long-term wealth preservation.
The paradox is completely solved. Investors aren't rushing back into real estate because the rental market is perfect. They're rushing back in because the alternatives have become mathematically unacceptable.
Cash is losing to inflation, and stocks are too volatile.
Real estate is the only logical life raft. So let's bring this macro theory down to the street level. Segment 4. Local market momentum. We know the capital is migrating globally, but what does this actually look like on the ground in South Louisiana, Mississippi, and Alabama?
It looks like a measurable, undeniable vibe shift.
A vibe shift in commercial real estate. I never thought I'd hear an analyst use that phrase, but it is accurate.
It's the best way to describe it.
The report explicitly states that the local multifamily market is showing steady, tangible improvement. Now, let's be responsible here. We are not back to the absolute insanity of 2021.
No, absolutely not.
We aren't seeing buyers waive all their inspections and buy properties sight unseen for $100,000 over asking price.
No, the speculative frenzy is dead, and thankfully so. What we are seeing is a return of professional momentum. Buyers are stepping off the sidelines.
What does that psychological shift actually look like for a buyer who has been frozen for a year?
For the last 12 to 18 months, investors suffered from perfect condition paralysis. They wanted the impossible.
Like what?
They wanted interest rates to plummet back to 3%, and they wanted sellers to panic and slash property prices by 30%.
They wanted to have their cake and eat it, too.
Exactly. But markets rarely give you perfect conditions. If rates drop massively, prices usually go up. If prices crash, it's usually because the economy is broken and banks won't lend anyway.
Right.
The psychology has finally broken through that paralysis. Investors realize that trying to time the absolute bottom of a market is a fool's errand. They are accepting the current reality of mid-6% debt and deciding to lean back in.
They want to find the deals that work today before the broader herd of capital rushes in and drives prices back up.
Exactly.
And we have hard empirical data to validate this vibe shift. This is exactly why Bridgewater Realty Advisors is the regional leader. They have the pulse on this.
They see the raw data before anyone else.
Look at their own active listings cited in the report. They have over 30 right now. That is a massive inventory pool to draw data from. But here is the statistic that jumped off the page.
Oh, this one is huge.
In just the past 3 weeks alone, the number of properties Bridgewater has under contract jumped from 1 to 7.
Going from 1 contract to 7 in a 3-week window is not a statistical blip. It is a massive spike in transaction velocity.
It's proof of concept.
That is alongside a massive uptick in property tours, financial underwriting requests, and general buyer inquiries. It is the clearest indicator of that pent-up demand we discussed. The capital that was hiding in savings accounts is finally deploying into the real world.
But the report is very careful to clarify how this capital is behaving. It states that while buyers are eager, they are underwriting conservatively.
Very conservatively.
Break down what conservative underwriting actually means for a buyer looking at a deal today versus 3 years ago.
Conservative underwriting means you build massive safety margins into your math. 3 years ago, an investor would look at a building, assume they could raise rents by 10% every year, assume their insurance would stay flat, and assume they could refinance at 3%.
It was basically delusional optimism.
It really was. Today, a conservative underwriter assumes rents will stay totally flat or even drop slightly for the next 2 years. They assume their insurance might jump another 10%.
They prepare for the worst.
They require a higher debt service coverage ratio, meaning the building has to produce significantly more cash than the mortgage actually requires. They are stress testing the asset to ensure that even if the economy hits a recession, the property will still pay for itself.
So they aren't relying on rent growth to bail out a bad purchase price anymore. The deal has to make mathematical sense on day one.
Precisely. Transactions require absolute precision right now.
So if the momentum is building but the underwriting is strict, what is the forecast for the rest of 2026? Where is the local market heading?
The report forecasts continued, accelerating improvement, driven by the easing of the two massive bottlenecks we've discussed.
The insurance and the interest rates.
Right. First, as the insurance markets in the Gulf Coast continue to stabilize, operating expenses become predictable again. Second, if the Fed does initiate rate cuts in June, the cost of commercial debt will inch downward.
Even a drop of 50 basis points, like half a percentage point on a commercial mortgage, can completely change the viability of a deal, right?
It unlocks massive profitability. It allows transactions that were completely dead in the water in February to suddenly pencil out and make sense in August.
So, assuming these tailwinds hold,
If these macro tailwinds hold, the Bridgewater data suggests transaction velocity will accelerate heavily in the third and fourth quarters as the pricing expectations of stubborn sellers finally align with the mathematical realities of these conservative buyers.
okay, we have covered a massive amount of theory. We've talked about global capital flows, Fed policy, and underwriting philosophy. I want to spend segment 5 getting our hands dirty.
Let's do a deal deep dive.
I want to look at the actual receipts. When the ink dries on a purchase agreement in South Louisiana right now, what does the math actually look like? Where are cap rates actually trading?
This is where we separate the professionals from the tourists. Let's look at the data.
First, we have to explain the methodology of the report because real estate data is notoriously messy.
It's incredibly messy.
Bridgewater compiled a list of multifamily sales over the last 180 days across their operating market. But to estimate the cap rates, the yield of the properties at the time of sale, they didn't just trust the seller's profit and loss statements.
No, you can never trust those.
They took the publicly advertised gross rental income, and then they applied a standardized 40% expense and vacancy assumption. I want to challenge that. Why apply a blanket 40%? Why not just use the actual numbers the building was operating at?
Because actual numbers in commercial real estate were often a total fantasy, especially in the sub-institutional market. Every owner operates their property differently.
Give me an example.
You might have a mom-and-pop owner who does all their own plumbing, mows the lawn themselves, and manages the tenants without any software. Their actual expenses might look incredibly low, maybe 25% of gross income.
Because they're doing all the free labor.
Exactly.
Yeah.
But if you buy that property, you're going to hire a professional property manager, a professional landscaper, and a real plumber. Your expenses will instantly jump to 40%.
On the flip side, you might have an owner who is terribly inefficient and their expenses are running at 60%.
Right. If you just look at the seller's numbers, you're comparing apples to oranges to bananas. By applying a standardized 40% assumption for expenses and vacancy, Bridgewater strips away the noise of individual management styles.
What does that 40% cover?
It covers property taxes, the high local insurance premiums, a management fee, maintenance, and a reserve for capital expenditures like roofs and HVACs. It creates a level playing field so an investor can accurately compare the yield of a fourplex in Metairie against a 20-unit building in New Orleans East.
It provides the raw baseline metric of the asset itself. And when you look at the spectrum of data they pulled using this methodology, the results are incredibly broad.
It's a huge range.
Across the region, cap rates range from as low as 5.10% all the way up to an astronomical 12.76%. And the price per unit metrics vary just as wildly, ranging from $45,000 a door to $150,000 a door.
What's fascinating here is what it reveals about buyer psychology and strategy in a high interest rate environment. Look at the low end of that cap rate spectrum.
The 5.00% deals.
Right. If an investor is buying a property at a 5.0% cap rate, but their commercial mortgage is costing them 6.5% or 7% in interest, they're experiencing what we call negative leverage.
Explain negative leverage, because to a layman, borrowing money at 7% to make 5% sounds like a phenomenal way to go bankrupt.
On the surface, it does. Negative leverage means the cost of your debt is higher than the yield of the property. In year one, that property might not produce a single dollar of positive cash flow.
Wait, really?
The investor might actually have to feed the property out of pocket to cover the mortgage every month.
So why do it? Why take that risk?
Because these buyers are playing a long-term game. They aren't buying for day one cash flow. They're buying for location and appreciation.
Ah, I see.
They are securing prime assets at a lower total purchase price than they could have gotten 2 years ago. They expect to slowly raise rents, wait for interest rates to drop so they can refinance out of that expensive debt, and eventually ride the appreciation of the neighborhood over a 10-year horizon.
Or, in some cases, they're institutional buyers paying all cash, so the interest rate doesn't matter to them at all.
It's chess, not checkers.
Let's break down the submarkets, because real estate is hyper-local. A mile can completely change the math. The report divides the map clearly based on risk and return.
Let's hear it.
In general, stabilized assets in stronger, historically desirable, higher-income submarkets, places like Uptown New Orleans, Mid-City, and Metairie, are trading in that tighter 6 to 8% cap rate range.
Right.
On the flip side, you see the higher yields, the 9 to 12% cap rates, in lower income or more challenging areas like New Orleans East, parts of Chalmette, Gentilly, and sections of the West Bank.
It is the fundamental law of investing, risk versus reward. The market assigns a higher yield to compensate the buyer for the perceived higher risk and higher operational intensity of managing a property in a rougher neighborhood.
Let's make this totally concrete. I want to walk through 3 specific sales from the report's data table to illustrate this entire spectrum.
Let's do it.
Let's start with example 1, the low cap rate, high price per unit scenario. 3 ago, 223 3rd Street in the Central City neighborhood of New Orleans. This is a 24-unit apartment building.
Okay.
It sold for $2.8 million. That breaks down to roughly $116,666 per unit. And the estimated cap rate is a razor-thin 5.10%. Walk me through the psychology of the buyer who wrote a $2.8 million check for this.
To understand this deal, you have to understand the trajectory of Central City. Historically, it was a disinvested neighborhood, but over the last decade, it has seen massive, sustained revitalization.
It really has.
Millions of dollars in commercial development, new restaurants, and proximity to the incredibly expensive prime real estate of the Garden District and St. Charles Avenue.
It is gentrifying rapidly.
Rapidly. The investor buying 24 units here is making a massive long-term bet on the continued stabilization of that specific geographic footprint. They look at $116,000 a door and realize that building that same complex from scratch today with current construction costs would be impossible at that price.
So they accept the low yield.
They accept the low 5.10% yield because they perceive the asset as incredibly safe long-term. They likely view this as an institutional quality asset to park wealth safely, expecting the value to compound massively over the next 20 years.
Now contrast that with example 2. Let's go to the complete opposite end of the risk spectrum. 10151 Curran Boulevard in New Orleans East.
This one is interesting.
This is a massive complex, 216 units. It sold for $9.75 million. That is only $45,138 per unit. It's less than half the cost per door of the Central City property. But the cap rate is an astronomical 10.63%.
This is the classic high-yield, high-brain damage scenario. Let's look at the reality of New Orleans East. Since Hurricane Katrina, it has been a structurally challenging submarket.
Very challenging.
It struggles with retail blight, higher crime rates, and massive insurance vulnerabilities. Operating a 216-unit Class C workforce housing property in this environment requires intense daily management.
You aren't just casually collecting rent on an app.
No. You are dealing with high tenant turnover, constant eviction proceedings, major physical maintenance issues on older buildings, and constant collection problems.
It is a grueling business model.
It is. So the market demands a massive risk premium. At a 10.63% cap rate, the day one cash flow on this property even with a 7% commercial mortgage, is likely incredibly strong.
The investor is trading the easy, passive appreciation of a prime neighborhood for the heavy, aggressive cash flow of a challenging asset.
Exactly. They demand nearly an 11% return just to justify the headache of putting their $9.7 million on the line.
It perfectly illustrates the trade-off. Let's look at one final deal, example 3, to find the middle ground, the sweet spot for the local investor.
It's a bread and butter.
Let's look out in St. Bernard Parish, 3316 de Lambert Street in central Chalmette. This is a classic 6-unit building. It sold for $450,000, which is exactly $75,000 per unit. The cap rate came in at 9.36%. Let's literally run the math on this for the listener to show how underwriting works.
Let's do it. A purchase price of $450,000 at a 9.36% cap rate means the property generates a net operating income of roughly $42,120 a year.
Okay, and if we use the Bridgewater assumption that expenses are 40%, that means the NOI of $42,000 is the remaining 60% of the gross rent. So the total gross rent collected over the year is about $70,200.
Divide that by 6 units, and you get $11,700 per unit per year. Divide that by 12 months, and it means the average rent for these apartments is $975 a month.
That is the perfect anatomy of a local deal. Why is a property like this so attractive to the market?
Because it fits beautifully into the reality of the local independent investor. St. Bernard Parish, and Chalmette specifically, has a strong blue-collar industrial economic base.
It offers tenant stability.
Exactly. And the price point, under $500,000, is totally accessible. A local investor can buy this with $100,000 down. They don't need a Wall Street private equity syndicate behind them.
And the return is solid.
At a 9.36% yield, it provides a very healthy return that dramatically beats inflation and bank accounts, with a moderate, entirely manageable level of risk. It is the absolute bread and butter of the South Louisiana multifamily market.
And when you step back and look at this entire data set, from the 6% yields in Uptown to the 12% yields in New Orleans East,
You are looking at the entire ecosystem of local real estate laid bare.
you are seeing the actual mathematical decisions of dozens of investors placing millions of dollars of bets on the future of this region, block by block.
Is the market speaking in absolute truth?
Which brings us to the end of our journey today. Let's quickly recap the massive amount of ground we've covered in this deep dive.
We covered a lot.
We started with the macro weather report. The Federal Reserve holding rates steady while telegraphing a shift for June. We looked at the temporary inflation spikes driven by global oil supply chains.
And a labor market that is finally fracturing under the weight of AI automation and an exhausted, tapped-out consumer.
From there, we traced how that macro pressure directly caused the violent correction in the rental market. We saw national rents fall to an average of $1,357 and leasing velocity stall out to 40 days.
As a flood of new apartment supply overwhelmed a stretched renter base, forcing landlords to bleed revenue through concessions.
But then we solved the paradox with the Great Capital Migration. We walked through the math of how, even though rents are cooling, the yields on safe bank accounts are dropping faster, creating negative real returns against inflation.
That dynamic is forcing massive amounts of wealthy capital off the sidelines and back into the stability of hard real estate assets.
Which is the exact catalyst for the local vibe shift we documented in South Louisiana, Mississippi, and Alabama. The paralysis is over.
Deal activity is surging from 1 contract to 7 in weeks. And while underwriting remains mathematically conservative, the smart money is aggressively positioning itself across that entire spectrum of submarkets we just analyzed.
We are watching a market in the middle of a profound historic transition. And trying to navigate a transition like this by yourself, relying on national headlines, is a recipe for losing a massive amount of money.
You absolutely need a guy who actually understands the local math.
I want to remind you that Bridgewater Realty Advisors is the leader in multifamily sales in the region, specifically because they're on top of all these data points for their clients. They don't guess, they calculate.
No, the number's cold.
If you are listening to this and you want to know the cap rate, the price per unit, and the rental trends for your specific neighborhood, maybe we didn't cover your exact submarket today, you need to get this intelligence in your corner. Reach out to Mason McCullough directly. His phone number is 504-298-5547, or you can email him at mason@bridgewater.realty.
Having that granularity is invaluable right now, because as we close out this deep dive, I want to leave you with a final thought to mull over.
Go ahead.
We just spent an hour mapping out the mechanics of capital movement. Money is moving, because sitting still in cash is becoming mathematically punishing. So imagine a year from now,
Okay.
when the dust finally settles on this transition, when the Fed finally executes those rate cuts and the cost of debt drops, a massive herd of uneducated capital is going to rush blindly back into the market and drive property prices right back up.
Right.
Will the investors who sat frozen in fear today, waiting for absolute perfection, deeply regret not locking in these assets during this quiet, brief window of conservative underwriting?
That is the ultimate question. It is like refusing to buy an umbrella because the sky is only cloudy and then paying triple the price for one when the hurricane actually makes landfall.
Yeah.
The smart money is buying the umbrellas right now. Thank you so much for joining us on this deep dive. It has been an absolute masterclass decoding this data with you. Until next time, keep your eyes on the math, and we will catch you on the next one.